Okay, so welcome everybody to today's presentation on a webinar on market valuations and self-managed superannuation funds. So it's an interesting subject matter in the sense that it's kind of been one of those evolutionary areas that's really sort of moved with, I guess, the growth of self-managed super funds, and so we're seeing far more relevance given to it as a subject with regards to the ATO. But also from a regulatory point of view. And I've got some stats that I'll show you a little bit later in the presentation that sort of back up, I guess, my thought processes in regards to where the ATO are sitting with references to market valuations, and therefore ultimately where we need to be not necessarily better, because I think many of us are doing the right thing with regards to valuations, but at least be on the lookout, because there's always you're always getting questions about these sorts of issues, and clients particularly who will want to look at, you know, whether they value something higher or lower for various purposes, and we've just got to, I guess, stay true to course with regards to what requirements are and how people can meet those requirements. So we're going to have a look at the market valuation considerations for a self-managed super fund. So when we need to look at the valuation issues there, I want to touch on a couple of cases. And so for those of you that have been to most of these webinars that I provide and run through SuperGuardian, you know that I've spoken about a couple of cases over the last couple of years, and I'll talk about the two of them today. WZWK and Coronica, and I've spoken about them both for other purposes, so often around pensions, often around investment restrictions, and other things. But both of them have historical issues linked with market valuations as well, and ultimately they were, when they've been disqualified as trustees of their fund, a lot of it's come down to their practices based on the fact that they were sort of quote unquote SMSF professionals in regards to the way that they portrayed themselves from an industry point of view, and they clearly did the wrong thing, and it's clear that they've done it for manipulative sort of legislative purposes. So just trying to address a couple of those, where the ATO sit with regards to this, what they provide from a documentation piece, related party transactions, and then just really the compliance considerations. So where do we sit from a penalty point of view with regards to market valuations? So let's sort of jump into why it's become a key sort of subject matter over the last, let's say 12 months, but clearly there's been a build up to that, and often I look at the issues that the ATO release from a compliance point of view, and you can almost draw a parallel between the ATO and Treasury and government releasing something, be it regulations or whatever, and then they go down the significant education campaign, and often those education campaigns can last, you know, without sort of overstating it, can last a decade. You know, you can have 10 years of the ATO sort of playing the education piece and really being promotional in regards to how people should do things from a fund administration point of view, from a fund compliance point of view, from a trustee obligation point of view, and then you see the ATO sort of take a far more compliance-based approach. And you know, it's not too bad. I think obviously for me they could start to take that compliance approach a little bit earlier to try and knock out some of the bad habits, because the education is there, the information is available, and it's not that any trustee, it's not that any SMSF professional can say, well, we didn't know that, or we didn't have access to that information, because there's plenty of information out there with regards to matters such as market valuation. But what we saw in 2024 was the ATO doing a targeted campaign. So I say that we see this a bit more regularly. This follows on sort of 3 or 4 years later from when the ATO did a targeted campaign around investment strategies and the need to diversify. But this one was, they targeted 16,500 funds and about 1,000 SMSF auditors with regards to the market value requirements under SIS Regulation 802B. Now, 802B is exclusively about the financial statements. So it was really about how the assets in the fund had been reported at the same value in some instances for the last 3 income years. And so realistically, what the ATO was saying is, please explain why is this the case? And from an audit point of view, right, why are you not reporting this? Why is there no ACR with regards to reporting under the operating standards and as such the market valuation regulations? So, it was an interesting sort of piece, sort of as a flow on from the diversification in that preceding sort of audit approach that the ATO had taken. And it certainly, I guess, triggered the industry to talk a little bit more about market valuations and the considerations and associated issues with it. And one of the things for me is that clearly what we're seeing is that the ATO are getting much better at collecting the data and analysing the appropriate data with regards to SMSF reporting. And I guess that also comes with consistency. The ATO have been the regulator for a long time. The regulatory report has consistently been updated in line with the various super reforms that have occurred. But each time we see the statistics coming out from the tax office, and we get our quarterly stats and then we get our annual stats, I think we're seeing better information being reported to us, and it's far more usable. So certain things like valuations is stuff that the ATO can certainly track moving forward, and it means that it means that by the ATO being able to track that better, it means that they can be quicker at acting on certain things. But also on the flip side, it also means that probably from an administrative point of view, as an industry, we're getting better at what we're providing the information, or how we're providing the information through the regulatory return. Now, whether that's consistency of the accounting platforms we're using or whatever it might be, but certainly I see that there's a lot of improvement there. So this is kind of the trigger for a lot of the discussion around market valuations that have occurred, certainly in the last 12 months. And so it sort of leads down the path of why valuations are important for a self-managed superannuation fund, and what that actually means for us with regards to the compliance piece for SMSF. So I've kind of taken a cloud-based approach to this to look at the key issues, because that ATO review was based exclusively on 802, Regulation 802B from the SIS Act, which is the annual statement requirement. So we know that there is a regulatory requirement, a SIS requirement to prepare financial statements, and which is Section 35B, and then a subsequent regulation, which is the 802B reg, which is there to ensure that those reports prepared for 35B are then done so at market valuation. I'll touch on when that came about and what it all means in a moment. But clearly we have to do our valuations for reporting purposes. Those changes, which did come in sort of 2012, 2013, were about because a self-managed super fund is a non-reporting entity, we didn't have to make reports, certainly not in the strict nature that, say, an APRA fund had to do with APRA as such. But we always had requirements to value assets, and one of those primary requirements was when we commenced a pension, right? So there's always been, not that it's been something that's been legislated as such, but it's always been certainly the practice from pension commencement point of view. So now, obviously, in a transfer balance cap position, but previously in a reasonable benefit limit position. So when we were paying pensions under the reasonable benefit limit, the requirements, the old ATO instructions around commencing a pension used to always say to revalue the assets immediately before the pension commence, so that you can you do your appropriate reporting for pension commencement purposes. And of course, that has flowed on in regards to the transfer balance cap to ensure that that people aren't manipulating things for the general transfer balance cap and personal transfer balance cap purposes. In addition to pension commencements, the other rule requirement that we had from a legislative point of view was our in-house asset ratio. And so we had a requirement where we had in-house assets held within the fund, that we had to do an annual valuation to ensure that the in-house asset ratio meant that the in-house assets represented, no more than 5% of the total fund assets. So we had those two sort of guiding principle requirements as to why we needed to do valuations inside a fund. We then had, by extension, section 66, which has our acquisition of an asset from a related party. And when you drill into the acquisition of assets from a related party requirements, the acquisitions must be undertaken on an arm's length basis. Now, of course, that led to the introduction of terms that were phrased within the ruling TR 2010-1, what is a contribution? Also, the other ruling, I think it was SMSF ruling 2010-1, acquisition of assets from a related party. And that talked through the requirements with regards to acquiring assets and what it ultimately meant. But there was a clear requirement there from a definitional point of view to deal at market value there. As I said, I already mentioned the transfer balance cap, but by extension, total super balance is now responsible for a lot of our decisions around contributions. And so when we're looking at concessional carry forward amounts, if we're looking at non-concessional cap and bring forwards, if we're looking at work test exemptions for those over 67 and the like with regards to any link to the total super balance, then ensuring the fund assets are valued appropriately is pretty important from a compliance point of view to accurately represent an individual's total superannuation balance. And I've been having a lot of conversations in the past sort of few weeks with regards to these recent legacy pension and reserve regulations that came in December. And one of the key issues that references me back to, excuse me, is the SMSF Regulatory Bulletin 2018-1, where the tax office introduced their position on the holding of reserves inside self-managed super funds with a real directive around the impact of reserves on total superannuation balances and with regards to ensuring that people weren't using reserves and making allocations to reserves to manipulate things like total super balance and transfer balance cap. And so it was a real sort of stated position from the regulator that they weren't going to accept after July 2017 the use of such structures inside self-managed super funds, the use of reserves to deliberately manipulate things like the total superannuation balance to ensure that people qualified for certain other conditions. Now, again, that to me is very much that red rag to a bull approach, which we do see quite often when we see regulatory bulletins and taxpayer alerts about structures that the ATO have identified. But often you see that it's being identified in a very small sample of self-managed superannuation funds, and it's the ATO then getting on the front foot and saying, we've seen this sort of behaviour. We want to make sure that more broadly people don't try to adopt these behaviours to manipulate numbers and things like that within their reporting requirements. So from that total super balance point of view, from the concept of reserves and all those other things, there was a key issue there. And then, of course, the other one, which has been really significant over the last four years, or it's actually been 6 years now, from a legislative point of view, but the focus on it has been pretty significant over the last 4 years, which was the non-arm's length income considerations. And of course, what we've seen a lot of activity on is the non-arm's length expenditure issue. But of course, the whole arm's length discussion really extends all the way back to sort of 2010, targeted around limited recourse borrowing arrangements and the whole concept of whether a transaction was an arm's length transaction for SIS purposes, which meant that the transaction could be no more favourable to the related party, but never really touched on the favourability to the SMSF, other than to say, hey, if it's more favourable to the self-managed super fund, then that's all bonuses to the super system. However, the tax legislation with the non-arm's length requirements under 295/550 bring that back or rein that back in to say that our non-arm's length considerations is dealing about all parties inside the transaction. I'm going to touch on that today as well. So, when we add all those sorts of green items up there, the key issues that deal with our requirements to go out and ensure that we're dealing on what we would perceive to be market value without putting any too much sort of, what's the word I'm looking for? I'm going to say regulatory because I can't think of the actual word that I'm looking for at the moment. Any sort of regulatory requirement on what a valuation actually means there. But then in red, I've got our collectible and personal use assets from disposals to related parties. Now, this is the first time legislatively that we've seen something introduced that sort of highlights what sort of valuation is required. And of course, in this instance, they required a qualified independent valuer. So the instance of self-managed super funds owning collectible and personal use assets, no issue with a self-managed super fund owning those assets. But what they wanted to ensure was that from a disposal point of view, if the super fund was looking to dispose of that asset to a related party, so the members of the fund, then they obtained a qualified independent valuation. And qualified, and I'll touch on those concepts again as we work through the presentation. So these are the reasons why we sort of need to consider valuations. It's not just about, despite the ATO focus, it's not just about the annual statements. That is clearly a driving factor, and clearly if we get things right for the financial statements, then we're going to get most of the other things right. Particularly, if we tick off the statements, then we're going to tick off the in-house asset ratio concept. If we tick off the annual statements, then we're going to be a lot closer to our pension commencement valuations being correct there as well. And then it comes down to our day-to-day transacting, so things like related party acquisitions and our arm's length requirements, to ensure that everything that happens during the financial year is then done on an arm's length basis to meet our market valuation considerations. So they're the principles that we tend to operate under in this space. And what I want to do now, as before I go through a lot of the key issues here, is really sort of touch on these two cases. As I said, I've spoken about them at length before, so I'm only going to highlight a couple of key points of each to show that the extent to which market valuations can create problems is not just around, say, the naive level of, say, new entrants to the SMSF industry, or people that have just joined and set up their own funds, or just don't. They talk about not having the financial literacy to be able to understand what they're doing in these transactions, which of course begs the question whether they should have a self-managed super fund. But that these market valuation issues expand beyond that to include SMSF professionals. Now, again, I'm not casting judgment on either party involved in these cases, albeit that I guess what I'm doing is making an assessment of their mindset behind the transaction and what they were trying to achieve. And clearly, these parties both had a good enough understanding of the legislative requirements to say, right, well, if I do this, if I deal in this space here, this is the outcome that I'm going to get. This is the outcome that I want to achieve. I want to get these assets into my fund, or I want to move these assets from one fund to another fund. This is how I'm going to do it, so that I can then get it ticked off by another party. So from a Coronica point of view, so I'm going to look at WZWK in a moment, but from a Coronica point of view, he clearly had a lot of experience, 50 years experience. Now, one of the key things about both of these cases were, from a transactional point of view, the key transactions that we're talking about from a market valuation point of view occurred prior to the regulatory requirement to value assets at market for financial statement purposes. However, what we're actually looking at here is more acquisitions of assets from related parties from a recording point of view, and then the in-house asset test. And of course, those rules were pre-existing when the financial statement valuation requirements came in. So, there's really no excuse to say that it didn't have the appropriate understanding of what the requirements were. Now, Coronica, for all of the issues, and there were about 45 contraventions that were identified in that fund there. So there were some significant considerations, happened primarily over 1 year. But the key issue from a market valuation point of view that the ATO went to court on was the fund acquiring 100% of shares in G Coronica Nominees Proprietary Limited, which was a company that was 100% run by Mr. Koronika. Now, and basically the company was largely an investment company. So the company in itself invested in other investments, which then had dividends and other things associated to it, which could then be passed on as a franking dividend from the or franking credit from the payout of that company to the shareholders. So there was a benefit in paying it from the company to the super fund because of a lower tax rate. Therefore, with the higher franking credit, the money would funnel back into the super environment. But the key here was that there's all the acquisition issues, say the 1322C issues here, which clearly to me were also in breach. But the way that he had undertaken his valuation was based a little bit on the expected return of those shares that were held within that company, and then the associated credits with that, but then the tax that it would be levied on subject to the end recipient. And he was basing his valuation on the shareholder being taxed at the top marginal rate. And so when he put his valuation together and came out with the valuation of $1 million, $100,000 for the shares, it conveniently, because his super fund was valued at 2 million, right, and what was stated was that 2 million was nothing illegitimate in regards to that 2 million and the valuation of the assets. That was a genuine investment, or the genuine portfolio valuation. But of course, 100,000 is a representative of 5% of 2 million. Now, the ATO have sort of came back and said, well, we actually value these above 200,000, and based on your own principles, where you're talking about incorporating effectively a tax liability, you've incorporated a tax liability for the highest marginal tax rate, whereas the super fund is going to be the owner. So we're actually looking at a 15% tax rate. So you're overstating the diminishing value in that regard. And so there are all these sorts of things that Mr. Koronika tried to argue were legitimate. But what was clear was he knew, despite it, when you read the court case, it goes through the concept of saying, we felt that there was an exemption to the in-house asset rules, right? But clearly, so if there was an exemption to the in-house asset rules, then there wouldn't be such a necessity to get under the 5% limit. So then why would you work so hard to get under the 5% limit? Clearly, they knew that they weren't going to satisfy that in-house asset requirement, which then poses the question, well, you can't actually make the acquisition in the first place, right? But from a valuation point of view, they were clearly trying to get under that 100,000 to say, okay, well, you can acquire shares in a company if it's not satisfying the requirements under 1322C, right? Then it's got to satisfy the less than 5% requirement at acquisition and on an ongoing basis. And that's clearly what they were trying to do with the 100,000 valuation. So that was basically squashed by the regulator and also by the court process there. Similarly, when we look at the WZWK versus Commissioner, this case was primarily about early access through a manipulation of the various conditions of release and the payment of supposedly a lifetime pension at a time frame when you couldn't pay lifetime pensions, but in the form of ceasing gainful employment and using that to be able to access their benefits as a non-commutable income stream. But in doing it, this client had Super Fund A and Super Fund B, and they transferred a lot of units in unit trusts held in Super Fund A over to Super Fund B, and the valuations were very low or almost non-existent because the trustee slash member slash accountant and auditor, so he had the full gamut of what he was doing for his fund. He basically did his own valuations based on there not being any certainty about the income that was going to be paid or the valuation of the units in these trusts, because they were based on contracts that the unit trust was expecting to hold. Now, there's a whole heap of other information there, but ultimately he was saying, well, there is no value in the trust because these contracts aren't guaranteed, and the tax officer in the court's position were, well, there is value because you know the value, you know what they're going to receive in those contracts, and so therefore, you know, you have deliberately undervalued them from an acquisition point of view. Now, the point of what I'm really getting at here is that both these cases highlight that people will work very hard to try and get an outcome to get themselves into the best position from a valuation point of view where they see opportunity. And it's our job to be able to say, hey, Mr. Karonika, if you're our client, we've got to look at the valuation of these shares. And first, we've got to look at the definition of the company to see whether it's going to satisfy the requirement. If it doesn't, then will it meet the in-house asset requirements from a valuation point of view? Because it's a related party acquisition, right? We need to certainly be far more diligent in accepting the valuation, because the key thing was Mr. Karonika was a valuer for other investments, and so he was often called upon for his experience, but he applied quite a different valuation approach to what he was trying to do. And so, you know, there's just key things that people need to be mindful of there. So really, I just wanted to highlight with those that there are issues that we need to make sure that we all address to make our clients comply with their market valuation requirements. So why are we here? Basically, in a very short form statement, this is just one of the many super reforms that we've seen over most of the people online's journey here. You know, we've had simpler / better / all sorts. This was stronger super. All right, so stronger super was the super review, the super system review from 2010, and it wanted to address a couple of key regulatory issues. So these I thought were good measures from a compliance point of view, because prior to these measures being introduced, I mean, the insurance one is always going to be and was controversial in the sense of, why does a trustee, or why should the trustee consider insurance if, for example, they're in retirement phase and drawing down a pension and they're not going to take out insurance? Why do they need to do that? That's obviously a subset for a whole different subject matter there. But other things like money and other assets of the self-managed super fund being held separately from personal assets, and then the valuation requirements, which were the two key measures to come in with the insurance piece there. And the reality was that there was already a covenant to keep assets separate, and there was obviously legislative requirements around in-house assets to value assets at market value, but there was nothing to compel trustees to do it. So under the operating standards reflect the regulations, and so by introducing regulations that impose the requirements to keep assets separate, by introducing regulations that impose a requirement to value the assets at market value in accordance with the financial statement requirements, it gives the ATO power to be able to ensure from a regulatory point of view that funds are doing what they're meant to do. So previously, prior to 2012, when the law came in, so the law came in from the 12-13 year, prior to that point, it was the bane of many auditors' existence. And I know, dealing closely with the auditors at the time, say, well, this asset's not in the name of the super fund. It's like, well, you can put that in your management letter, but there's not a lot more you can do. So you can ask, and then you can ask again, right? You can keep asking the trustees to do the right thing, but the ATO can't do anything other than recommend they do the right thing. But these powers, and certainly from a valuation point of view, you can say, well, you know, to get a true representative of what your account balance is, it's in your best interest to value the assets at market value. But there was nothing as a non-reporting entity that compelled them to do that. And so by regulating it, putting it in the regulations and making it form part of the operating standards, it basically meant there was the trustees were compelled to do so. So that's sort of how we got to this point. And we saw the introduction of SysReg 802B, right? And that was a requirement that for subsection 35B2, which is around the accounts for a fund, from 2012-13 and any later years, when preparing accounts and statements required by subsection 35B1, an asset must be valued at its market value. Right, we then jump across, and that's of course for the preparation of statement of financial position and operating statements. And then we have to look across at our definition of market value, which of course is defined in the SIS Act, means the amount that a willing buyer of the asset could reasonably be expected to pay to acquire the asset from a willing seller if the following assumptions were made: that the buyer and the seller dealt with each other at arm's length in relation to the sale, and that the sale occurred after proper marketing of the asset, and that the buyer and seller acted knowledgeably and prudentially in relation to the sale. So that's our requirement there. And of course, that sort of gives us our general guidance in regards to what we need to do from a market valuation point of view, but it still does give some form of scope to be sort of manipulated without a deeper dive into some of those specific terms, such as dealt with each other at arm's length and considerations. And so what we then have to look at is we have to go one step further. And when we look at that one step further, we say, okay, well, what does it mean to deal with each other at arm's length, right? So we look at the SIS Act, and SIS Act gives us Section 109, right? And that requires the trustees to deal with each other at arm's length in respect of any transaction, and where the parties are not at arm's length, such as when they're related, the trustees must deal with the other party as if they were related. And then the terms and conditions must be no more favourable to the other party. So this is what I was talking about before, right? Under the limited recourse borrowing stuff that occurred back in 2010, SIS Act basically imposes a requirement that we've got to deal with each other on arm's length, and we'll expand on that definition in a moment. But the terms must be no more favourable to the other party. And probably for me, this is one of the times when I sort of hand on heart say that I think the ATO have erred in the information they've provided us from a regulatory point of view, because I'm a big fan, and always have been a big fan of a lot of the SMSF rulings that they've released over time. I've done a lot of work with a lot of clients now based on information in determinations, based on information provided in interpretive decisions, but they released a couple of they weren't interpretive, I think they might have been determinations or whatever at the time, or ATO-IDs, interpretive decisions in regards to limited recourse borrowing arrangements. And they were very specific that they were only relating to the SIS side of things. Right? And I think the fact that the ATO only looked at the SIS side of things back in 2010, it's led us down this following 14-year journey of arm's length considerations and non-arm's length considerations that I suspect could have been nipped in the bud very early had the ATO addressed the non-arm's length considerations of the Tax Act in that original 2010 interpretive decision around the limited recourse borrowing arrangement and the interest percentage that was charged on some of these loans. That's just a thought process that I've always sort of followed along with, that we've copped a lot of, not grief necessarily, but a lot of uncertainty in this space over that one interpretive decision and then the material that followed on from that. Because the ATO had already addressed in tax ruling 2006/7, which dealt with the old special income, which is what became non-arm's length income in the 2007 super reform. But under that previous ruling, the ATO had started to address the concept of what it meant to deal with somebody on an arm's length basis. And I think that kind of often got lost in a lot of the translation beyond that point in time, because the fact that it had been touched on prior to all of the LRBA stuff being introduced, to me, felt that they could have dealt with it a lot earlier. And so one of the key things that the ATO did address and come out with was that you're dealing with each other at arm's length in relation to a transaction if the independent minds and wills of the party are applied to the transaction and their dealing is a matter of real bargaining. Right? If this is not the case, the Commissioner will consider the parties are not dealing with each other at arm's length in relation to the transaction. Right? To go further, if the relationship of the parties is such that one party has the ability to influence or control the other, this will suggest that the parties may not be dealing at arm's length, but it will not be determinative. Parties that are not at arm's length can deal with each other at arm's length in relation to a transaction, and parties that are at arm's length can deal with each other in a way that's not arm's length. So what they summarised really with those three paragraphs from TR 2006/7 was the relationship is core, and the influence of the parties in the relationship is core to the capacity to be able to deal at arm's length. It is not a requirement that all parties are related or unrelated to make you question whether transaction is going to be dealt with from an arm's length point of view. It ultimately comes down, did you act independently, right? So in negotiating your outcome, right? So you being one party, you being the self-managed superannuation fund, right? Did you negotiate the terms of the transaction based on what was best for the super fund, right? Without consideration or without whatever else is in the offer from the other party, even if those parties were separate. So it's often about the scenario of, okay, if there's a benefit, if there's some other benefit associated with this transaction to deal with this person, right, then will that determine something to be at arm's length? And that's a really difficult thing to determine. And so obviously it's clearly more beneficial when we can have independent parties dealing with self-managed super funds in regards to related party transactions. If you can get someone else to be able to provide valuations, it clearly makes things more streamlined and easier to deal with. Because otherwise it comes back to the point that the trustees are just going to have to justify that transaction when dealing with the ATO, or more importantly, when dealing primarily at first point with the fund auditor. And so understanding and working through all of those sorts of things is going to be key. So when we look at the ATO's position on this, we've got a couple of areas that are worth reviewing. And I go through and read these, particularly the second one there, the valuation guidelines for self-managed super funds. I go through and sort of refresh myself on these whenever I'm doing a webinar like this, but if I'm talking to anyone in regards to related party transactions, I try to look at these things to what they mean, because what the valuation, so you got your market valuation guidelines for tax purposes, that is quite a detailed document there. But the SMSF valuation guidelines, it talks about what the ATO's approach is, talks about why assets need to be valued. So we've already addressed those issues. So all of that my cloud-based slide before, that was all the issues, or the primary issues that the ATO have addressed as why assets need to be valued. We then need to consider who the valuer is, and then what genuine valuation or general valuation principles apply. So as I touched on before, the key to collectible personal use assets is that if you sell them from a self-managed super fund to a related party, the valuation must be performed by a qualified independent valuer. So the tax office go further and say, if the value of the fund asset represents a significant proportion of the fund's value, then their preference is to see a qualified independent valuer as well. So it's often from an audit point of view in the best interest of the clients to consider that. Or the nature of the asset indicates the valuation is likely to be complex or difficult. So you're wanting to get some professional in to be able to potentially provide that valuation. And of course, that comes at a cost, and I'm going to touch on the cost element of that. I'm not going to talk about how much it costs to get a valuation, but the consideration piece of, if you need to go down the path outside of collectible and personal use assets, but somewhat inclusive of, if you need to go down there, then we have to work out what the purpose of that investment is from a super fund point of view. So when we're looking at qualified independent valuers, they need to be qualified through a formal valuation qualifications, or basically by being considered in the eyes of whatever industry they are, whatever profession, as knowledgeable and understanding of all of that information. So all those road shows that you sell, those roadside selling shows, buyers and sellers and stuff, where you've got your experts going around, going and obtaining appropriate valuations. You've got coin shops, you've got all those sorts of places that you can go to obtain your appropriate valuations from a client point of view. And then from a general valuation principle, you've got this obligation on trustees to demonstrate that the valuation based on fair and reasonable process, based on objective and supportable data. So when you go through that valuation guideline for self-managed funds, it talks about what are the requirements, and all of them say, well, you need it to be fair and reasonable and based on objectable and supportable data. And of course, objective and supportable data is going to be different for each sort of asset class as well. And the ATO do provide some sort of information to assist us in regards to that area. So if we look, for example, at property as an asset class, you know, and these guidelines that I'm providing here, my caveat to this would be is talk to your own fund auditor first to see what requirements they have with regards to valuations, because some, you know, will have a little bit more expertise based on their own audit experience as to what valuations they accept. Others might require far greater breadth of information to be able to support what they need from a valuation piece. So, you know, when we're talking about real property, independent appraisals from a real estate agent with supportable evidence, contract of sale, if it's a recent purchase, you know, and no events have occurred to the property that could impact its value since then, recent comparable sale results, rates notices, if consistent with other evidence or valuation. So, you know, I think historically, certainly I know from my own admin experiences that a rates notice alone hasn't always been considered acceptable as a way of determining what the valuation was or is for a property point of view. Net income yield of commercial properties, and again, it's not sufficient evidence on their own and normally would need some additional information. What's less acceptable? So I say less as opposed to not acceptable. It's going to be, say, real estate agent online valuation service appraisal, saying what something is likely to sell for. So again, if you're going to say that this property, we think this property is valued at this, right, then you want to have that supportable data. So comparable sales from either in the same area or the same size and in recent times and other things to be able to provide it. So, you know, as I state there, it's not necessarily going to be a single item, but multiple. And so the first real place to have that conversation is with the fund auditor, which kind of takes me to before I talk about things such as companies and trusts and other things. If we talk about assets without a ready market, so I made the comment before around when you might want to get a qualified independent valuer coming in, but I touched on the various valuation guideline issues. And so the ATO in their valuation guidelines made some commentary in regards to investments without a ready market, right? And one of the comments that they made is it's unlikely that an asset with no known value or potential for capital or income growth would be considered a prudent investment to support members' retirement goals. So this comes back to probably the key thing that we have to address with regards to the valuation of an asset is from a sole purpose test. And you know, you could link every conversation we have around super back to the sole purpose test. But from a sole purpose test point of view, why is that investment in the self-managed superannuation fund, right? Is it there because it is generating a certain amount of income? And if it's generating a certain amount of income, you know, is there then something supporting the valuation behind why you're valuing it as such, and that might have some benefit to it. But if you say if it's not generating a lot of income and it's almost I'm going to call it a compassionate investment. And that's not the word I'm actually looking for, but an investment where somebody it's almost like there's a love affair with the asset class, and it might be the personal use and collectible type assets. Sort of might be artwork, might be wine, might be those sorts of investments. The real consideration has got to be is, yes, but is this going to provide for my retirement, or do I just love the investment class, but it doesn't necessarily have the value attached to it that's going to meet my sole purpose requirement, which is providing retirement benefits for me. You know, so it's not just about the valuation on a year-by-year basis, but also your capacity to then subsequently dispose of that investment, right, at that point in time where you're wanting to start to draw down an income from that fund. And then the consideration of, well, if the disposal is then, because you love the assets so much, if the disposal is then going to be to a related party, you know, can you get a qualified independent valuer in to do that appropriate valuation? Now, of course, the reality is things like wine, things like artwork, and jewelry and all that sort of stuff. Then there's definitely people out there that can do that valuation. But the appropriateness of the investment linked to the market valuation requirements, linked to with collectible and personal use assets, all of the other storage and other considerations and insurance considerations, you have to question whether or not it's the appropriate place for these investments to be held. But that's for each individual trustee to determine on their own. So again, then we look at unlisted entities, so independent appraisals of investments held within the company or trust with supportable evidence, property valuations if it's the only asset of the entity. And this is one of the things, because often you'll have a unit trust or something else that might hold property in there, and as themselves non-reporting entity, the valuation or the valuation is not a requirement. Often those investments might be held at cost base. And so if they're held at cost base, it's not truly reflective of the value of the investment the super fund's made, which is the units in the unit trust or the shares in the company. And so therefore it doesn't reflect going through that process of being able to calculate total super balances, to be able to report for financial statements and all those other purposes. So again, is there a property in the trust or the company? Is there a current valuation attached to it there? Are there recent comparable sales between the unrelated parties? How did the directors or the trustees substantiate the valuations? What method was used? So you look at the Coronica case, for example. One of the difficult things again is the valuations provided by financial statements. And again, I've used not acceptable there, but I think again it's one of those less acceptable concepts in the sense that if you are taking information from financial statements that are provided on behalf of the unlisted or the private company, where are the valuations to support that? So has an independent valuation of the share values been provided in that regard? So you do have to do a little bit more work in regards to that space. And of course, you have to be mindful of such things as to whether or not any significant events have occurred, because if a significant event has occurred, then there might be a requirement to obtain new valuation. So if we go back to that tax office communication where they said funds hadn't been revalued in the previous, or assets hadn't moved in the previous 3 years, many of us our first sort of thought process was, well, wasn't there, or wasn't the requirement that you had to value the assets at 3 years? And again, it's another one of those sort of superannuation myths as such with regards to 3-year valuations. And it was more that that because there was, prior to 2013, there was no requirement to value the assets, it was almost deemed acceptable that if nothing had changed, then 3 years was an acceptable time frame to not get an additional valuation done. But the reality is, the requirement really is there now to do it on a yearly basis. So again, obtaining new valuations, valuations obtained after the event has occurred, right? Obtaining alternative evidence to support the value of the fund assets. So when there are significant events, we need to determine whether that's going to have an impact on the fund. What are our significant events? Obviously disasters, pandemics, macroeconomic events, market volatility, and changes to the character of the assets. So if improvements or anything else are done to the fund. I've seen that the questions come in. So for a private company, can you use the last sale price for the shares times the number of shares to be the market value? So that will come down. So basically, if you've got shares in a private company and there's been recent sales of those shares, the short answer would be you possibly can use that valuation, but you're going to have to look at how recent that sale was, right, and what parties were involved, because there might not have been market valuation requirements for those that previous sale. There might have been other events that I don't mean to use the word tarnish, but that determined that a different valuation was used for the sales of those previous shares. So I think it's a really good starting point to be able to, if you've got recent share sales of a private company, to be able to utilize that. But realistically, you're still going to have time frame considerations to ensure that, for example, no significant events have happened with that company that would significantly alter the value that's occurred in that time. So yeah, I think it's a good starting point, but it's not necessarily going to be the only point that the trustees accept, or sorry, that the auditor will accept. So if I talk about the non-arm's length asset acquisition consideration. This is one of those areas that I guess is really the flow on, because if we take as an acceptance the valuation piece that we're required to value the assets at 30 June at market value, then we get ourselves in a consistent place where 30 June we're looking at the valuations, we're trying to obtain them, we're going and seeking previous sales or whatever else might be the scenario. We've then got our acquisition considerations that we always have to be mindful of. And I think this is one of those areas that is still a bit of a moving beast at the moment. So we know that Section 66 does have the requirement for all acquisitions to be undertaken at market value. And so therefore, if we're buying an asset from a related party, so listed shares, business real property, certain in-house assets and exclusions to the in-house asset rules, then we have to undertake those transactions at market value. Now, listed shares is ultimately a relatively straightforward process, because you've got the shares on the day that you're going to acquire them, and ultimately that's going to be your value. Things like property transactions and investments in related trusts, related companies can be that slightly bit more problematic, and you need to do your due diligence to ensure you get your valuations correct. But when we link the Section 66 market valuation requirement with the arm's length requirements under the SIS Act, but also the arm's length requirements under the Tax Act, we have to be really mindful of what we're trying to achieve. And this, when I go back to that definitional stuff from TR 2006/7, and particularly also in light of I say the finalisation, it's in draft format of LCR 2021-2, which deals with our non-arm's length expenditure piece. What we're looking at here is that there has always been a fix for self-managed superannuation funds, and that fix has always been, in a practical sense, if the trustees didn't pay the full amount from a valuation point of view, then we treat the difference as a non-concessional contribution, and then everything becomes market value, right? That's been in a very sort of simplistic way. That's been the fix since sort of a number of rulings were released back in 2010. One of those rulings being TR 2010-1, the contribution ruling. As part of all this non-arm's length income and non-arm's length expenditure legislation, we've seen a shift in the wording of tax ruling 2010-1 around in specie contributions. And ultimately it comes down to contracts. And when we purchase something under contract, if the contract price doesn't represent market valuation, then by applying the in specie requirements to top up the valuation to treat it as market valuation doesn't wash under the new requirements. And the ATO have made that clear in their amended version of TR 2010-1. On the other hand, if you enter into a transaction and the contract stipulates that the market value is X and the purchase price will be made up of a cash purchase of A and an in specie contribution of B, right? So it's upfront in regards to how it is represented, then there's no problems there. So this is still going to play out a little bit with how the ATO will sort of apply their TR 2010-1 and their LCR 2021/2 with regards to the acquisition of assets. But from a practical point of view, we've just got to make sure that our clients are in all circumstances trying to deal at market and then making the determination whether the acquisition is a purchase, right? And so therefore all fund cash is being used, or a contribution, therefore they're being made as non-concessional, or a combination of both, and then documenting that appropriately. So what I want to finish off with, talk about just for the last couple of minutes, is our compliance side of things. So in the last week or so, I think it was, the tax office released their annual statistics. So they do their end of financial year statistics as to where super funds sort of are sitting, self-managed super funds, how many funds, demographics, investments and other things. One of the things they always do is the audit statistics for the number of contraventions that are reported, and those numbers are relatively consistent over the timeframes, and so is the number of funds that report rectified breaches. But what's interesting is that that certain things, so loans to members or the provision of financial assistance, still remains the number one breach from a compliance point of view, and that's of course quite problematic. But when you compare these statistics to the previous year's statistics, what you will see is that all of the percentage of all of those breaches have come down. So member loans, in-house assets, separation of assets, with the exception of administrative issues. So trustees that have got some administrative issue, that's gone up. Breaches of the operating standards, that's gone up. And breaches of the arm's length rule, that's gone up. So those three there, to me, incorporate the hidden requirements that market valuation brings. So the separation of assets, the market valuation requirements, the arm's length transacting, because of the emphasis that the regulators had on such an issue with the legislative change to 295 550 and the non-arm's length expenditure stuff, there's clearly a greater focus on it from a regulatory point of view, and there's clearly a greater focus on it from a fund audit point of view. It means that these admin breaches are going up, these operating standard breaches are going up, and these arm's length breaches are going up, only ever so slightly. So not significant numbers, but it means that people are looking at these matters certainly more than they were before. And so we know that if there are breaches in regards to this place, then from a regulatory point of view, there can be an enforceable undertaking, there can be a rectification direction given there. There can be admin penalties. In the worst case scenario, you've got disqualification, civil and criminal penalties, and notice of non-compliance. So your WZWK and your Coronica, they sit down in that bottom three category: disqualification, penalties, and non-compliance, primarily because how significant and how much value and how much disregard to the law there was. Most self-managed super funds, we know, have, for a lot of these penalties, have access to the administration penalty regime, which the ATO can apply without having to go to the courts. But you do have your civil and criminal penalties for things like the sole purpose test, the in-house asset requirements, which includes the market valuation ratio stuff there, and then the arm's length requirements. The acquisition of assets, that can result in, I've never seen it, but that can result obviously in a prison term. Seems to be fairly extreme for inadvertently acquiring an asset, which is probably why we've never seen it apply there. And then you've got your 10 penalty units for breaches of all the collectible and personal use asset requirements. And so when you look at sort of the key ones, and I've kept a couple others in there like borrowings or whatever, because borrowings tends to be linked around the non-arm's length expenditure piece with whatever the borrowing arrangement is in the first place, and a breach of an LRBA ultimately becomes a breach of Section 67. But our operating standards has a 20 penalty, admin penalty units. Our accounts and statements, so our market valuation requirements under the 35B, come under 10 penalty units. The bigger investment restrictions, so borrowing and in-house asset requirements, at 60 penalty units. And those penalty units are $330 each now. So as you can see, it adds up. If you are a breach of your financial statement requirements, and each trustee is going to be up for $3,300. So to summarise, we've got to make sure that all our transactions continue to be undertaken in arm's length terms, which requires obviously that things that market valuation is applied and adhered to. The supporting documentation that is required is important to understand. So when you've got to substantiate these things, having your documentation and discussing it with the fund auditor, I think is a real positive step to trying to work through almost the pre-audit process. So having an understanding of what your auditor wants pre-audit will allow you to flow through that audit process a lot easier. I think, and today the Div 296 is meant to be debated, but hey, we've heard that about 1,000 times already. If Div 296 becomes a thing, right, then valuations are clearly going to be an important issue inside the superannuation industry, because valuation is going to impact that $3 million and obviously any amount over and above that. So it's going to be a key issue there. So having an understanding of the transactions, to have an appreciation of what the valuation requirements are, is really critical, particularly for us as SMSF professionals, to be able to discuss these matters with our clients as such. So what have we got coming up? 18th of March, our next webinar will be on how indexation impacts strategic considerations. So really looking at the fact that the general transfer balance cap is going up to $2 million based on the recent indexation figures from the 1st of July, what impact that has strategically on pensions, contributions and other things. So that's what we're going to talk about on the 18th of March. And then our following webinar there will be on the 15th of April. I'm working through that probably depending on the needs and wishes of people, and depending on how the government act, we might do something in regards to legacy pensions and market-linked pensions and things, and the commutation requirements there. So look, thank you very much for attending today's webinar. As always, SuperGuardian will issue you with a copy of the slides and the CPD certificate. So those will flow through to you in the next few days. Thanks for joining me, and I look forward to you being on board at the next webinar in March. Thanks again.